If you think California tax audits happen randomly, think again. Most businesses are chosen on purpose because their numbers don't match. Doesn't match information obtained from third parties, or their industry reporting raises statistical red flags, or their filings tell a different story than what the state already knows about you. Whether it's income tax, sales tax, or payroll tax, each California agency, the Franchise Tax Board, the Department of Tax and Fee Administration, and the Employee Development Department, they run their own audit selection systems. And if your data just doesn't line up right, you might already be on one of their lists. Hi, I'm David W. Klasing. I'm a dual licensed tax attorney and CPA, and I've spent nearly 30 years, multiple decades, helping California businesses and their owners survive audits from the FTB, the CDTFA, and the EDD. Today I'll break down how each agency chooses who to audit, what patterns they look for, and what steps you can take right now to lower your chances of becoming their next target. California doesn't rely on random picks. The state tax agencies use data matching, analytics, issue-driven campaigns to find likely non-compliance. They are integrating AI-driven audit selection into their audit selection process as we speak. They compare what you filed to what third parties have said about you, like banks, vendors, and payroll processors. If something doesn't line up, your file gets flagged for audit. Each agency focuses on different triggers. The FTB looks for missing income, aggressive deductions, and residency issues. The CDTFA focuses on underreported taxable sales or questionable exemptions. The EDD hunts for contractors who should be employees, amongst other things. The Franchise Tax Board audits individuals, corporations, and partnerships. They start by matching your W-2s, your 1099s, and K-1s against your California return. If those numbers don't reconcile, you move up the audit list. They also review federal data about you. If the IRS changes your taxable income via audit, California often follows with its own audit to confirm state results. FTB also flags patterns that historically lead to adjustments, like large Schedule C losses with weak support, losses flowing to owners that don't have basis, big swings in apportionment of California sales, credits or NOL carryovers that don't match prior year filings, and one of their biggest focuses, residency and sourcing. If your filing claims you left California but your lifestyle and electronic footprint still point back to California, expect an audit. The CDTFA builds sales tax audit leads from patterns in your reporting. They run ratio analysis comparing taxable sales to purchases and industry norms. If your taxable sales look too low relative to inventory purchases, or if your exemptions seem unusually high, your file gets picked up in the sales tax audit queue. They also cross-check business licenses, resale certificates, and federal income tax filings to find sellers who appear to be underreporting. High-risk industries that are often cash-intensive get audited a lot. Restaurants, liquor and tobacco retailers, convenience stores, contractors, medical offices with mixed sales, e-commerce companies. Once flagged, the CDTFA may use sampling or observation tests to estimate missing sales tax, and if your records are weak, those estimates often work against you. EDD audits are randomly rare. They usually start with a triggering event. The most common? A worker you paid on a 1099 files for unemployment or disability benefits. That claim alerts EDD to a possible misclassification, and your company becomes a California employment tax audit target. Other triggers include late or missing payroll tax returns, mismatching between 1099 payments and DE9 seed filings, referrals from the IRS, FTB, or the CDTFA. The EDD applies an ABC test, which presumes a worker is an employee unless the company can prove all three prongs of independence. If you can't, they'll reclassify the contractor, assess up to 3 years of back taxes, and add penalties that can literally financially cripple a business. Across the FTB, CDTFA, and EDD, the logic is the same. Your payroll tax filings must tell a consistent story. If payroll records, sales tax filings, and income tax returns contradict each other, you've given the state not one but 3 reasons to come audit you. Consistency and documentation are your best defenses here. While you simply can't make yourself California tax audit proof, you can make your file a poor target and set yourself up for a no change if they do audit you. Here's how. Match W-2, 1099, and K-1 data before you file. Reconcile sales tax journals, merchant statements, and exemption files. Keep proof of residency and sourcing, like travel logs, customer locations, and contracts. Report federal audit changes within 6 months of them occurring. File and pay your taxes on time. Non-filers and late filers top every year's audit list. Above all, make sure all your California tax filings tell the same story. If you've been selected for audit, if you've already received an audit notice from the FTB, the CDTFA, or the EDD, the best thing you can do is stabilize your files immediately. That means filing your power of attorney, organizing your records, hiring a dual licensed tax attorney and CPA to get involved in your audit early. Earlier the better. Once we step in, we take over communication with the auditor, we verify statute deadlines, and we wind up preparing the exact schedules that the auditor is going to build before they actually do it. That way your case stays focused and under control. Listen, if you've been contacted by any California tax agency, the FTB, the CDTFA, or the EDD, don't wait for the situation to escalate before you get us involved. Call the tax law offices of David W. Klasing today at 800-681-1295 or visit klasing-associates.com to schedule a confidential, reduced-rate initial consultation today. We'll stabilize your file, we'll protect your rights, and we'll drive your case towards the best possible outcome.